Hey, this is Brian McCarthy coming to you from the frozen tundra once again with a very quick update on the Japan intervention thing. I did a video on this yesterday about the Treasury possibly being involved in selling dollar yen to help out the Japanese. And I think here's what Scott Bessent is thinking and where I think he might be miscalculating. So I think the Treasury Secretary is concerned that the sell-off in the JGB market is going to bleed into the Treasury market as yields rise in Japan. Those bonds become more attractive to Japanese investors who might sell Treasuries. And there has been consistent talk that the move in JGBs is infecting the long end of the Treasury market. Also, if the Bank of Japan sells dollars to support the yen, then they presumably source those dollars by liquidating Treasuries. The more support they have from the US, the easier it will be for them to stabilize the market with dollar sales, and they would have to sell fewer dollars and liquidate fewer Treasuries as a result. I see a couple problems with this line of thinking. One, there's nothing unusual about what's going on in the long end of the US Treasury market lately. The moves have been completely consistent with the fact that we're getting strong data that suggests nominal growth in the US is, after a dip through the middle of 2025, is probably going to close 2025 on a very strong note, above 5% on nominal final sales. So there's no reason to be pushing Treasury yields, below 4% in the 10-year, as long as the economy is continuing to grow. Now, if the labor market continues to roll over, bonds will rally again. I don't think it has anything to do with Japan. And on the flip side, I think there's a big risk because foreigners the world over, I talk to a lot of clients in Europe and Asia and elsewhere, they're generally very freaked out about the policy volatility coming out of the US, and we have this sell US narrative that's gathering steam again. And what's one way to push a sell US narrative is to have the Treasury Department suggest they'd like to see the dollar lower by engaging in intervention. That could trigger selling of US assets that infects the long end of the yield curve. So I see this differently than I think the Treasury Department might. I don't think the problem with Treasuries was coming from the JGB market to begin with. And as I suggested yesterday, I see much more risk than potential reward for the Treasury to be engaging in this intervention activity with the Bank of Japan. So we'll see what happens. Dollar yen, lower again today. And at this point, just the calling around they did Friday's done the trick. So there's nothing imminent as long as markets continue to behave from their perspective. But if we start trading back up to $156, $157 yen later in the week, I think there'll be a very real risk they'll be in. And let's see what Treasury decides to do then. Thanks a lot.